The stock market has gone insane. Over the past few weeks, we've seen a bunch of 10% drops, as well as some days where the market just decides to shoot up by 10%. A lot of people don't really understand why. A lot of beginner and intermediate investors make their worst mistakes in this time right now. They just get overwhelmed by emotion and don't know what to do. Or they just panic sell or they panic buy. So here on this episode today, I'll be going over two of my biggest mistakes. And these mistakes weren't made necessarily during a time where it looks like a recession's coming. It was during a time where there was a lot of volatility in the market. Without further ado, let's get right into it. Welcome back to The Fire Grind. On this channel, we talk about anything and everything that has to do with personal finance, especially how you and I can become financially independent and retire early. On this episode today, I have a few things planned. I'll be going over my Wealthsimple portfolio and various things in the portfolio that have happened, including one referral that I recently received. So if you haven't already joined Wealthsimple, now might be an awesome time to start getting in and averaging in as the market goes down. All you can do is just go down into the description below. I have a link there. You get $5 and I get $5 for signing up. So we're in my portfolio right now and we can see that my account today we're down about $98. That's just less than 1%. However, if we go all time, it's actually dropped about 40%. So a lot of people would be pretty scared by that. However, for me, I'm gonna average into the market. So for me, I'm not too scared about losing 40% currently because a lot of this is really technically considered paper money. And by paper money, it means that it's only until I sell the stock has it become the realized loss or a gain. So currently, because I haven't sold it yet, I haven't lost or gained anything. And I do strongly believe in long-term investing in the market and that eventually the market will recover. And I'm guaranteeing that my portfolio will eventually go green again one day. So in the meantime, really, all this is saying is that my portfolio is on sale by 40%. And who doesn't like going shopping when it's 40% off at any sort of store? So now jumping into the referral section, as you can see, I haven't earned any referrals to date. However, I have one pending referral and one referral that I can claim. So thank you to Akash. I assume you're one of my viewers online. Thanks for just signing up through my link. So here we go, let's claim it. So I'm gonna add this to my personal account. And voila, I've earned $5 to use towards my next trade. And so have you, Akash. Great, now let's get back to the portfolio. Let's switch over to the dividends. So here we're in my activity feed and I've also filtered it out so we only show the dividends. So we can see that I've earned multiple dividends in this past week. Starting from March 12th, we earned some Waste Connection, Sierra Senior Living, we have some Morneau Chappelle, we also have some Parkland Corp, Chartwell Retirement, Slate Office, AltaGas, Canadian Apartment Retailers, and Interpipeline. So overall, just doing some quick math, roughly I think we've earned about $15 in dividends, even though the market has probably dropped around 10 to 20% in the past week. So these companies will continue paying out dividends, and as I get more and more money and invest more into these individual stocks, these dividend payments will grow. Now let's jump over and fund my account. As I mentioned, I'm going to continue dollar cost averaging into this portfolio because stocks are technically on sale right now. So let's throw in $500. So we've deposited $500 and they're asking me to confirm, and we have confirmed. So this money will come into my account 3 days from now. So if you haven't already, just hit the subscribe button so that you can see what I put my money into, because I definitely will be buying some stocks once this money comes into my account. So lastly, we're going to go over some of my biggest losers and why they recently dropped. So first of all, we have Aritzia here. It's actually dropped quite a bit in the past while. We can see that it was at $25 at one point, and now it's sitting at around $11.99. That's more than a 50% sale. And the reason for the drop is that they decided to close their stores. In spite of this virus that's going around. For that reason, people are just worried that they're not going to be able to make a big enough profit this quarter. These store closures are very short term and their online sales are still active. So people who actually want to shop at Aritzia, I'm sure they'll find a way to do so online and order online. Another position that's down big right now is Canada Goose. And this one has been going down for quite a while just because when China initially got hit with the virus, they saw a tank there because their business is heavily dependent on the Chinese luxury goods market, especially their growth. And for this reason, they dropped, as well as recently as it hit North America, their sales are also going to continue to drop here as well, and they've closed their stores here. The one bright side for Canada Goose is that they've actually started to open up their stores in China, so they're starting to generate sales there as people come out of hibernation. Another stock that I just want to mention here is actually a stock that's held up very well. It's Kinaxis. It's still sitting around 102 and its highs were at around 120 at some point. And the reason why this stock has done so well is because their supply chain software. And what supply chain software is, they help companies manage just their buying and selling of goods, mainly to do with their manufacturing overseas, and how they can manage the inflow of their inventory from overseas. And in times like this where you don't know if your factory is closing, Kinaxis is a great software for companies to use in order to manage the changes in the factory closures from a day-to-day basis. So I think all these businesses closing and factories shutting down is actually benefiting Kinaxis because companies are looking for a way to deal with all this fluctuation in their supply chain. Lastly, I want to highlight Lightspeed. This is another stock that's dropped actually 50% for me. And at one point I was almost double my money on this stock. So we can see that this stock has really just swung up and just came crashing back down. And this is because this company recently IPO'd and they currently don't generate profits, as well as their product is actually sold to small and medium businesses. And in times like this right now, those are the businesses that get hit hard the most because they generally don't have the capital in the bank to be able to continue paying their employees, as well as their business is dependent on their day-to-day customers. But when everyone's staying inside and not going out to eat as much or going out to shop as much, Lightspeed will probably get hit. However, I do believe this is going to be a short-term thing. In a year or so, I'm sure this will blow over, and this company has a lot of growth ahead of it, so I'm not too worried about this position. Rather, I might be picking up more shares once my money comes into this account. So that about ends it for the portfolio update. Now let's jump into the two biggest mistakes that I've made in the stock market. Before we get into the next part of the video, just smash the like button so that you can help me feel better about my 40% losses in my portfolio, as well as just sharing the stories I have so that you guys can learn from them. So the first mistake that I have happened in 2018, and this is when the trade war started, as well as big tech was getting scrutinized by the governments over privacy. There were also lawsuits that were going around on Google and Facebook, especially Facebook. They had stuff that was happening over the election. This was starting to hit some sort of climax at that point, and people were kind of scared. They started selling out of the stock market in fears that the trade war and this big tech would have an impact on the entire market. In addition to all this, companies' valuations were actually quite boosted as the stock market had run up since Trump's election and not seen any signs of slowing down, so the PE ratios were fairly high in comparison to historical averages. By high, it's around the low 20s, and historical averages is maybe in the mid-teens. So there was also news that was being released about a recession is coming as soon as the downturn started, and there's a lot of fear going on in the market, but we know that Warren Buffett says when there's fear in the market, you should be greedy. And this is a paraphrase of his famous saying, but we should realize that when there's a downturn in the market, this is when stocks go on sale. However, I did not exactly hold to that. I was trying to time the market instead. And I figured if a recession were to happen, the stock market would drop 40 to 50%. Because this is what we saw with the dot-com bubble. There was a drop of 43%, and with the 2008 financial crash, there was a drop of 51%. So I was going to time the market and wait till it dropped to about 30% and start averaging in. But when it dropped that far, I don't even know if I would have had the guts to go in. And this time, as you can see, my mentality has changed and I've learned from that. I'm starting to average in as the market drops 20, 30, 40%. I even started averaging in while it started dropping 10%. However, if we look back at history, the market started to actually skyrocket back up. And the turning point was December 21st. And a lot of people attribute to the markets rising at 35% from December 21st to December in 2019 is due to the pension funds. And the pension funds, they usually get their cash infusion in January when people have more contribution room and they decide to deposit into there. So these funds get a lot more money coming in and they start to buy up. And they bought fairly aggressively because they saw the market was down 17%. But we don't know exactly how everyone was thinking, but we have some good indicators and a lot of data to back this up that's been researched by other professionals. From this 2018 situation, I've learned that I need to dollar cost average into the market. And the reason is I can't time the market. I don't know when the bottom is going to be. It's possible that all this fear currently in the market is priced into it after it's dropped down by 25 to 30% today. There is no rationale as to why this is happening and why it sold off so significantly. We don't have any numbers yet to back up, but this is purely speculation by investors. There is some signs out there that stores are closing, but we don't know what the true impact is. And the stock market is usually a reflection of what people think is going to happen in the near term as well as the long term, but more so the near term. But in the long term, as a long-term investor, I do believe we as a global economy will recover eventually, whether that be 2 to 3 years from now or within the next 6 months. So for now, I'm going to be buying into this weakness. The next regret that I have is actually, some people would call this a success, but it's a lesson that I've learned where I sold out too early of a stock that did very well. And this stock is Shopify. I was buying Shopify fairly heavily in my portfolio around the 120 mark. And this was, I believe, in 2017 or so. I might be wrong, but I'll throw a chart up here so you can see when it was around the 120 levels. And there was a lot of ups and downs in Shopify's earlier history. There was a major short seller. This guy went by the name of Andrew. He was from Citron, and he was saying that their business is purely drop shipping. Everyone should get out, and he announced that he had a massive short position. And a lot of people listen to this guy. I'm not really sure why, but he seems to always get a lot of things wrong. And once again, he got Shopify wrong. Shopify kind of went up and down between 200 and 130 or so. And eventually it broke out because the earnings were great and they've done very well in growing their business. And eventually Andrew left, admitted that he was wrong about Shopify, and actually he actually said positive things about the business and retracted his statement about that the business is going to zero. So this caused the stock to shoot up. And as the stock started to shoot up, I sold half my position at 250. And this is not the part I regret. I do believe it was a good move for me to sell at 250 because that essentially doubled my original cost basis. So everything that I had left in the stock was purely profits. However, I sold out at 330 or so afterwards, and that's where my biggest regret was because the stock continued to rise. And I think my regret came because I lost sight of the fundamentals of the business and my long-term belief of where the business was going to go. And we can see that the stock continued to roar up to $700 at its peak in 2 months ago. However, it has come back down, and I'm looking for an entry point to buy into the stock. But my mistake of selling out at 330 was that I tried to gamble it. I thought that I could sell out now and that the stock would definitely drop and I could buy back lower. I knew that the stock would go up over time in the next 5-10 years just because the e-commerce growth in this world is just astronomical. We've gone from 0% e-commerce sales to like 15% right now in the USA. In China, it's probably even more insane than that. So Shopify has a huge total addressable market ahead of it. I believe the online sale market, the e-commerce market, is actually currently at 2.8 trillion, and it's predicted to grow and double in the next 5 years. So for Shopify, there's a lot of tailwind to the business, and selling out at 330 was definitely a bad move on my part. I should have looked at more of the business fundamentals. They do have a strong balance sheet, and the leadership team is amazing at Shopify. A lot of talent in Canada is trying to get into Shopify, and we know that they have the best tech employees in Canada right now. So ultimately, my biggest mistake with Shopify is not looking at the tailwind that they have going for them. This being, they have the best talent in Canada because everyone wants to work for Shopify right now. They also have a total addressable market that's growing double digits year over year. We're only at 15% online sales in America, and think of what would happen if that went to 50%. And I can definitely see that happening as millennials come into the workforce and they're earning more and more money. They're really the drivers of online shopping, as well as Gen Z as they come in the next 10 years. In addition to that, they have a great leadership team that is just leading this company. They have great employee perks and they're retaining all their talent. And also just the way that they're dealing with the whole beer sickness that's going on right now, it is very responsible. So in all, I am very happy to invest in Shopify again. However, I am thinking of opening a position as the prices come down to maybe the 450 level. This is not me trying to time the market. It's just because I don't have the cash currently to buy many shares, and I do want to average into this. And with the $500 that I deposited recently, I want to spread it over other stocks that I mentioned earlier. So if you like this video, again, just smash that like button, and hopefully I've convinced you to do so with these two stories. Click the subscribe button if you want to see what's happening in my portfolio when those $500 come in, as well as leave a comment down below if you have any questions or just want to chat about anything. Keep up the grind and have a great day.